Ambitious people are built different. They expect better outcomes, not only from their time and effort, but from their money as well. Most investing advice exists for good reason. It protects the most vulnerable investors. In fact, according to a statistic, 91% of individual traders lost money last year alone. But if you have ambitious money goals, a genuine risk appetite, and you want your money to work as hard or even harder than you, then this general investing advice does not do you justice. There are more things to understand as compared to the standard playbook. When it comes to investing, what I have observed is there are no rules, there are only consequences. Hi, I'm Varun. I spent the last 8 years in asset and wealth management industry, and I used that experience to make myself financially independent at the age of 34. And today I will walk you through my personal money framework which I have built based on 10 years of investing knowledge, summarized into a few core principles. If you have ambitious money goals, this video should help you figure out where you stand and how to plan forward. But wait a minute, how can you be sure that this framework is really for you? Well, let me start with my background. It was the year 2020. I had a few lakhs invested in some flexi-cap mutual funds after paying off my education loan. I got married and I had one big goal in my mind. I wanted to achieve financial independence so that I could pursue some ambitious career goals. Well, I'm telling you all this because I want to start with a disclaimer. My journey and the principles that I'm about to share are a little bit unconventional. As I have already mentioned, they are more suitable for someone who describes himself or herself as growth oriented or an aggressive investor. If you are not sure where you stand on the risk metric, I have attached a simple risk questionnaire down in the description below. It's worth taking a look. As Benjamin Graham, the father of value investor, puts it, an investor's chief problem is the investor himself. To be a better investor, you first need to understand yourself. You need to understand your goals, your ambitions, your temperament, your fears. Because together, they make something called a investing personality. And this personality eventually drives your investment journey. With that disclaimer out of the way, I hope you're sure if this framework is really for you or not. So let's get into it. Simon Sinek talks about golden circles. For any organization, the inner circle is the why, the reason for which the organization exists. The how and the what can be figured out later on. Starting with why matters because it directly speaks to the part of the brain which controls decision making and behavior. The same applies to your money goals. Your why needs to be clearly defined for you to actually achieve it. Once a goal is measured and time bound, you can build an investment plan around it with a lot more precision. It also tells you whether the goal is realistic or too ambitious, whether you need to be conservative or aggressive with your investments. And if you do need to take higher risks with your investments, then that leaves you with two options. Either increase the amount of capital invested or increase the amount of returns expected. And well, if you don't need to take additional risk, then you might as well do fine with a conservative investment option. This isn't just a financial exercise. It's actually a step in preparing your mindset for what needs to be done to get there. High risk, high return investments come with some real volatility. And unless your why is strong enough, the pain is simply too unbearable, which is exactly what makes investors exit the investments at the wrong time. In my case, the goal of financial independence was so strong in my mind that I was ready to undertake any kind of volatility or uncertainty. I have actually made peace with 50% declines in my portfolio for a year or more. Investment returns come down to three things: the amount invested, the rate of compounding, and the time for which the investment has been made. Since the rate of compounding can only go so high, and the time tends to be limited by your actual needs, the only one lever left in your hands is the amount of savings, the amount of capital that you are ready to invest. And your savings increase disproportionately as compared to your income. Let me explain. Here's a simple example. Say you're earning 1.2 lakhs a month with 1 lakh in expenses. Your savings is 20,000. Now, if your income goes up to 1.5 lakh, that's a 25% increase in income, but your savings more than doubled. That's the leverage income growth gives you. This effect is strongest in the early years of one's career. Expenses do tend to creep up, but if you are deliberate about it, you can keep them contained to what actually matters to you. And this ties back into something that you've probably heard before about compounding. Most of wealth shows up in the later years, which means if you can defer big ticket expenses towards the later part of your life, then the expenses will hurt a lot less by the time you get there. A bit like the kids in the famous marshmallow experiment conducted in the 1970s, who sort of understood the concept of delayed gratification. I asked my wife not to expect us to invest in a house or do any big ticket expenses, at least in the first 10 years of our marriage, because then that gave me a runway to build serious wealth for me to take on challenging career goals. Scott Adams has a line that I think about a lot. If you want success, figure out the price and then pay it. For me, meeting my financial goals was success. I figured out the price and then I paid it. To beat the broader market, the price is conviction. Real conviction, backed by thorough research and evidence, not just a feeling. And I learned early on that if I was serious about my goals, I would need high conviction, high performance investments and the volatility that comes attached with it. So, how does one actually get there? Well, two ways. Either do the research and acquire the conviction yourself, or pay someone who does that job for you. In India, there are some vehicles such as flexi-cap funds, small and mid-cap funds, PMS and AIF, among other options, built for investors who are ready to pay for this conviction. Diversification means spreading your capital across assets which do not move in sync. This is essential so that your whole portfolio does not take a hit all at once. The real problem isn't diversification, it's over diversification. Let me explain. Say you have identified a great company and the stock price goes up by 200% in a year. Now, if your portfolio was spread across 50 companies, your overall portfolio, because of this one stock, only moves up by 4%. You found a genuinely good opportunity, but over diversification killed most of the upside. It's fairly well known in investing circles that diversification matters less for people who really understand what they are investing into and the underlying risks. Even Warren Buffett puts it like this: diversification is a protection against ignorance. It makes very little sense for people who actually know what they are doing. I want to be clear about what I am saying. I am not telling you to go all in one or two stocks. That's not conviction, that's recklessness, which is usually dressed up as overconfidence. What I'm really saying is there's a difference between narrow and wide diversification. Spreading capital across different asset classes such as stocks, bonds, gold, real estate protects the most risk averse investors. But if you are more risk tolerant, a higher proportion of your capital invested into high risk and high return investments, narrow diversification makes a lot of sense. You still keep some cushion for times when these assets underperform, and you might need to pull some money out, let's say for an emergency. But the bulk stays allocated to the best ideas most of the time. Now, if you genuinely don't have the stomach for that kind of volatility, or you depend on your portfolio for, let's say, passive income, your need to avoid deep decline in your portfolio is very real and legitimate. But most people early in their careers do not have this need, which is why this distinction matters. A good rule of thumb is if your portfolio keeps you awake at night, then either you are under diversified or over allocated to risky assets. I've learned this one through my own mistakes, and that's why this principle is part of my framework. Having high conviction investments do not automatically guarantee that you hit your goals. It's also a well known fact that Warren Buffett accumulated 99% of his net worth after the age of 50. Compounding shows up late in the process. Most investors don't actually lack insight. It's the discipline to stay invested through the thick and thin. Good investors need a rare combination of speed and patience. Speed, because in today's digital AI accelerated age, no good idea stays undiscovered for a long amount of time. Once you find it, you need to move fast and make your investment. And patience, because it actually takes a lot of time for the wealth to build and show up. And if you're investing systematically, staying the course matters even more. Because most developments in the economy, good or bad, only move prices in the short term. If an investment has a genuinely superior intrinsic value, the market tends to recognize it eventually. If you have made it this far, I request you to please hit like and subscribe. It would help me immensely. My goal with this channel is to bring you unique insights with all things money, investing, personal finance, and taxation. The insights which are drawn from my own investing journey, which would help you become a better investor. So, those are the core principles that I used to maximize the odds of hitting my goals. What I'm really trying to do here is critically examine some of the traditional investment advice and help you figure out which parts are worth questioning for your unique situation. I want to leave you with this: understanding your risk appetite, clearly defining your money goals, and getting honest about your real purpose is the real first step. Everything else in this framework is driven by it. Oh, and one last thing worth acknowledging. There's always a piece of this that's completely out of your control. It's called luck. Luck plays a critical role in investing, just like how it does in everyday parts of our life. Even if you do everything right, there's a chance that the market might not agree with you, at least in the short term, if not longer.